think one problem they have is they really need to wean the markets off of this forward guidance. They need to say we're data dependent, every meeting is live, and so forth, so they have flexibility. Having strong forward guidance makes sense when you have rates at zero and you're trying to prevent long rates from going up, but they're in a new phase now, and so somehow they have to wean the markets off of this certainty of forward guidance.
I think there's been a huge shift in investor sentiment. Basically, no one's talked about the January bounce. If you go back into December, I would have thought that we would just now be starting to have the market sell off as we go into the Fed meeting tomorrow. I think investors now are very fearful, certainly in the middle of yesterday, of losing a lot of money. And so Netflix is a good case in point. I think the earnings in Netflix were very positive, but yet they gave kind of muted guidance forward, and you see how much that stock sold off. So I think that in the past, up until now, we were looking for dips to buy. I think you can still buy some dips, but I think you have to be very careful because investors are looking for reasons to head to the sidelines because of increasing interest rates and sort of the valuation dislocation.
I would say the market feels fragile. But whenever things feel fragile and we think a lot of things are half empty, right, because we're fearful of the Fed and the geopolitical tensions plus inflation, that means we're pricing in a lot of bad news. And I think that's the perspective that's important to keep in mind, is that this doesn't mean to get out of stocks at all costs. This does mean first half is going to be treacherous, which it's proving to be, but this is going to be a great setup for a second half.